Assalamualaikum warahmatullahi wabarakatuh. Today, our group will be presenting about our class assignment. So, for this assignment, we have chosen Maybank Islamic Berhad as our subject of research. There are a total of 11 questions that need to be answered based on the bank's annual report or the bank's Audited Financial Report, and also what we have learned in our class. So, let's get to the question and answers, shall we?
Hi, hello. I'm gonna start with the first question, which is about risk management framework. So this will be based on the bank itself. It is an empowering capacity that enhances the activities of the bank and expands the probability of achievement in accomplishing their key objective. So next, as the risk management is a main regimen of controlling the bank that is supported with a lot of key standards which fill in as the establishment in driving the solid risk of management culture, practices and also procedures. Therefore, the determination and particular of security control for a framework is cultivated as a component of an association-wide data security program. It is also tied with overseeing vulnerability and forming a situation which the risks are limited. So the report is categorized that the practice has to recognize chance as to decrease potential negative effects and also improve the probability of gainful results. So next, I'm going to explain about the risk management process that is also based on the bank perspective itself. So it is a tool that is used for a business organization to simplify the potential risk into detailed specification by following the guidelines that involve identification, measurement, controlling, monitoring as well as reporting. So the practice of the bank will empower the organization to efficiently recognize the chances of risk exposure over the bank. So the risk management process involves 4 steps, which are identification, measurement, controlling, monitoring as well as reporting. For identification, it is to identify, understand and assess risk inherent in product, activities and business initiative. So this will enable the bank to identify the potential risk at the early stage so that the risk can be controlled by the bank. For measurement, it is a measurement of risk estimation strategies across different elements of risk component to guarantee that persistent reassessment and recognizable proof of risk and measure total exposure of the bank, individual business and also country, the risk types as well as the short and long-term effects of the exposures. The next process is the controlling, which is established quantitative and also qualitative control, including risk limits and triggers to oversee and manage the risk exposure identified. Therefore, by implementing the risk mitigation technique which aim to minimize the assistance or prevent the potential risk from occurring from the bank. The next one is monitoring and reporting. So it is the key indicators and early cautioning signs to guarantee that adequate and opportune activities is set up. So this is to evaluate the potential risk to the bank and also reporting the condition of the consistent to the bank management committee and also to the board all times. Next, I'm going to explain about the risk appetite that is based on the report of the bank itself. So the risk appetite is a critical component of a robust risk management framework which is driven by both top-down board leadership and bottom-up involvement of management at all levels. So the establishment of risk appetite is to enhance the board and senior management to communicate and also understand as well as analyzing the level and also type of risk which the bank is eager to acknowledge for the business goals. So next, I'm going to explain about the oversight functions of the bank's directors, which is to recognizing the importance of the sound risk management and also internal control system. So the board has established the governance. Besides that, the structure and framework also has been established to ensure effective oversight of risk and control. So the board is the overall responsible for a sound risk management and internal control system, and also reviewing the adequacy and effectiveness to have a better performance in the bank. So for the next question is about the 3 lines of defense of Islamic Bank Maybank Berhad. So for the key responsibilities in the first line of defense is to consist of business and support unit with the ultimate responsibility to manage day-to-day risk inherent in its business activities and risk exposure. The second one is ensuring the business operates within the established risk strategy, risk tolerance, risk appetite, and also risk framework, policy and procedures. And next is to establish within the business sectors, the business risk unit ensure effective risk oversight and also implementation of risk framework, policies and procedures and clarity in the risk management practiced. So the second line of defense, it involved the IMB, which stands for Maybank Islamic Berhad Sharia Management. It is to ensure that all structure, terms and conditions, legal documentation and operational process, flow and procedures are Sharia compliance. And the next is MIB compliance function, which establishes compliance framework and policies which provide advices and guidance on all areas of regulation and all over the effectiveness of the compliance control abandoned in the business. For example, risk of non-conformity and non-compliance with applicable laws and regulation as well as internal regulation. It is also to provide guidance in the implementation and execution of the established compliance framework, policy and tools. Moreover, based on the risk management function, they establish risk framework, policies and procedures to identify and assess, monitor and report all the risk types which form part of business day-to-day operation. It is also responsible for communicating risk strategies and creating risk awareness within the entire organization, and at the same time to provide guidance in the implementation and executions of the established compliance framework, policies and tools. So for the third line of defense, which involve group internal audit, which to provide reasonable assurance via regular and independent assessment and validation that risk management and compliance framework, policies and tools are sufficiently robust and consistent with regulatory standards. And the second one is control to mitigate risks are adequate and efficiently executed by the risk-taking units. And the third one is adequate oversight by the risk control over the risk-taking units. For the MIB Sharia review function, it is to provide independent and periodical assessment to improve the degree of compliance in ensuring a sound and effective internal control system for Sharia compliance. Moreover, it is also continuous review of process and deliverable, as well as determining that such process and outcomes comply with the Sharia requirement. So all these 3 lines are defense in Islamic governance model, which provide a transparent and effective governance structure that promotes active involvement from board and senior management to ensure a uniform view risk. So all these functions are different, which carry different rules in order to establish procedures, policies and framework for the bank to use as a tool to control potential risks in the bank.
I will be presenting about the 4th question, which is how the bank identifies and mitigates a credit risk in murabahah financing. But before that, a credit risk occurs when there's an exchange of asset between the Islamic bank and the customer. But the definition of credit risk is when the customer fails to fulfill his or her obligations to pay back the payment to the bank after it has been borrowed. In other words, it can be a loss of receivables to the bank. Okay, for the first identification, we will start off with corporate and institutional risk. For these two parties, they are assessed by business units and evaluated and approved by an independent party within the group itself. Next, for the borrowers and customer side, reviews are conducted at least once a year with updated information about the borrowers or customers' financial position, market position, industry and economic condition, and also economic conduct. For retail and credit exposures, there are reviews also made on credit programs at least once a year. And for counterparty credit risk, the evaluation is made depending on the positivity or the negativity value of all future cash flows. The second one is how the bank mitigates credit risk in a murabaha financing. So, for counterparty credit risk, the bank monitors and manages exposures within limits at all times, and this point must be adhered to Bank Negara Malaysia's single counterparty exposure limits. Next, for large exposures and undue concentration of credit risk, there are limitations and also guidelines that must be followed at all times. For the third point, which is risk levels of borrower and transaction, the bank has implemented risk-based authority limit structure, where this structure is based on expected loss, principles, and internally related to the fourth point, which is credit risk rating system, or CRRS. CRRS is made for corporate, commercial, and also small business credit risk. It is also made to identify, assess, and measure corporate, commercial, and small business credit risk, so that the bank can approve or not approve their borrowing situation. For retail portfolios, they are measured by Basel II Advanced Internal Ratings Based Approach, or AIRB. This approach calls for more extensive reliance on the bank's own internal experience, whereby the retail portfolios are being calculated with three components, which are risk-weighted assets, probability of default, exposure at default, and also loss given default. For on-balance sheet counterparty risk exposures, risk treatments are implemented. But for off-balance sheet counterparty risk exposures, credit risk equivalent via the current exposure method has been implemented. After that, bank also mitigate credit risk in murabaha financing through collateral. The collateral can be in terms of auto financing, share margin financing, commercial property financing, and others. Besides that, reconciliation of allowance account also being implemented to mitigate the credit risk in murabaha financing. And finally, for credit quality of financial assets, this is the final mitigation method that being implemented by the bank to identify the borrower's financial position, so that the bank could approve or not approve them to make borrowing or financing. So, this is the credit quality for financing position that has been implemented by Maybank Islamic Berhad. So, let's move on to the fifth question, which is how do we calculate the returns on mudarabah investment deposits and also return on equity. So, for RMD, in the Audited Financial Report, the bank stated that for 2016, they have gained For net income, about that much of value. For total mudarabah investment, it is that much of value. Therefore, their return on mudarabah deposit, investment deposit, is around 0.1766. But for 2017, the net income is this much of amount, while for total mudarabah investment, it is this much of amount. Therefore, the RMD is 0.2072. So, from these 2 years, we can say that 2017 is performing better than 2016. This is because the RMD for 2017 is higher than 2016. Therefore, the higher the return, the better the performance of the bank in managing its funds. For return on equity for 2016, we can see that it is lower compared to 2017. So we can say that if the bank, we can say that the higher the return on equity, the better the bank at utilizing its funds and also providing return to its investors. Therefore, we can say that 2017 Audited Financial Report shows that Maybank Islamic is performing better than 2016. That's all from me for question 4 and 5. Thank you.
Hi, Assalamualaikum. For question number 6, it is to analyze and discuss the bank's Islamic Securities Board of Help for Trading, which is STE, and financial asset held for trading is also known as financial investment designed to add fair value through profit or loss. And the securities held for trading can be calculated by dividing the financial asset held for trading with total asset. Okay, for Maybank's 2070 ratio of STA, it is 0.0036, and for 2016 it was 0.0042. Okay, and through observations from the calculations, it can be seen that there is a decrease in the ratio of securities bought for trading from 0.0042 to 0.0036, and these values are deduced from the years 2016 to 2017, and this shows that the bank gains less profit in assets in 2017 compared to 2016, and this is also an indicator that shows the loss of liquidity and asset value from the bank. And for question number 7, which is to critically discuss bank's income gap. Okay, gap analysis measures the difference or gap between the absolute value of rate of return sensitive assets and rate of return sensitive liabilities, which are expected to experience changes in contractual rates over the residual maturity or on maturity. A rate sensitive gap greater than 1 implies that the rate of return in sensitive assets is greater than the rate of return in sensitive liabilities. And as rate of return rises, the income on assets will increase faster than the funding cost, resulting in higher spread income. Okay, a rate sensitive gap less than 1 suggests a higher ratio of rate of return in sensitive liabilities than in sensitive assets. If rate of return rises, funding costs will grow at a faster rate than the income on assets, resulting in a fall in spread income, which is net rate of return income. Okay, gap analysis measures the sensitivity of bank profits to change in market interest rate, and the formula is the amount of rate sensitive asset minus the amount of rate sensitive liabilities.
Hi everyone, my name is Faisal. I apologize for my voice, I'm not feeling that well. But yeah, I'll be discussing on questions 8 and 9. So for question 8, it will be on discussing the use of derivatives in a bank and for what purpose. So derivatives are so hold on. Okay, derivatives are, it's a contract that derives its value from performance of an underlying entity. So what this is it can be futures, it can be options, it can be even warrants or bonds, currency, or even security. So when the price of the underlying changes, which is an underlying asset, because derivatives are, they are arrangements whose values actually derives and dependent on the value of an underlying asset. So this asset can be, like what I mentioned just now, commodities, currency, security, and so on. So when the price of this asset actually changes, the value of the derivative changes as well. And when this actually happens, it will change its value in the price of the underlying asset. So some of the most common derivatives used in the current financial world would be stocks, bonds, futures, and these derivatives or assets, they can also be purchased through brokerage firms, where you will have to deal with brokers and so on. Also, they can also be traded over the counter as an exchange, which would be off-exchange trading. This is to allow trading of derivatives or assets like what I mentioned just now, and somehow trading derivatives from OTC, which is over the counter, they usually have a higher possibility of counterparty risk. So counterparty risk would be the possibility of parties involving in the transaction, they might actually default. So this is the counterparty risk. So besides that, derivatives are also exchange off traded, besides that, derivatives are also traded exchange off. They are standardized and continuously regulated. So from my annual report from Maybank Islamic, the bank, it can be seen that the bank uses derivatives such as foreign exchange contracts, cross-currency swaps, and also profit rate. So these values of these values of the instruments used, the derivative instruments used, they are usually recognized initially as zero. So this is at inception for non-option derivatives, which is equivalent to the market premium paid or received for purchase or written options and so on. So how this actually happens, the derivatives are then remeasured at their fair values in order for them to retain, and then fair values are values obtained from the market. These are active markets. I'm talking about active markets, such as this will be including recent market transactions. This will be including discounted cash flows, option pricing models, and so on. So apart from that, I think any gains of loss or losses arising from the changes in the fair value of the derivatives would be recognized in the statement, in the profit or loss statement, unless there's a hedging relationship. I can go a bit deeper into hedging, but it takes time, as in it's deeper. But yeah, that's my answer for question 8. Question 9, on the other hand, question 9 would be, in Malaysia, the Islamic Financial Service Act 2013, which is IFSA 2013, requires separation of funding into deposit funds and investment funds effective from June 2014. Critically analyze the shifting or allocation of funding to deposit and investment funds as of December 2014. So we are talking about IFSA 2013. So in 2013, the IFSA Act 2013 was formed. So what happened in IFSA 2013 was that IFSA 2013 divided the deposit funds and investment funds into two separate entities, as in they're completely different, they are completely independent, and they are not dependent on each other. So before IFSA 2013 was actually formed, the three contracts that actually fall under the category of savings account would be Wadiyah, Mudarabah, and Court as well. but due to the uncertainty that Mudarabah contract possess, so what Mudarabah contracts possess is the fact that Mudarabah contracts, you cannot predict the return. You cannot predict the return of investment. So when that actually happens, it's very hard, it's very hard for it to be complying under Sharia law. When it comes to Sharia law, Mudarabah contracts, they are looked upon as investment contracts. So when this happens, you actually have to shift it. I mean, in IFSA, you actually have to change it. You have to look at Mudarabah contracts as investment accounts rather than actually saving accounts. So this took place after the formation of IFSA 2013. Before formation of IFSA 2013, Mudarabah contracts, they were actually categorized under savings account. So when they were categorized under investment accounts after IFSA 2013, then this led to the formation of Mudarabah investment account. Mudarabah savings accounts or Mudarabah current accounts, they will be carrying their own profiles. This is under, when I talk about profiles, this is under risk categorization. So risk categorization is completely something else. This will solely depend on the portfolio or the characteristics of the projects or of the investment assets in the projects. So listed in my report would be the different levels of risk. So firstly, I will be talking about low risk investment account. So low risk investment account, this will be involving investment projects that have a low expected return, and usually these projects, they involve a very short tenure period. So this is low risk investment account. Secondly would be a medium risk investment account. So in medium risk investment account, as in this would be relatively involving projects that have a rather normal expected rate of return, a medium rate of return, let's say, okay. And this usually would be involving projects that have a very diversified portfolio. The last categorization would be the high risk investment account. High risk investment account is slightly different than both of the investment accounts I mentioned earlier. So high risk investment accounts, these are specifically for projects that have, it's a high profile project. These are projects that are very high profile, involving high expected returns. They also have a very volatile, they are also volatile in nature. And when this happens, they will be categorized under the high risk investment account, under Mudarabah. So overall, even though I believe that IFSA 2013 was to rectify and to improve regulations, and also in terms of recording transactions and so on, it was decided that Mudarabah accounts, they are actually not covered by PIDM after IFSA 2013. PIDM would be Perbadanan Insurance Deposit Malaysia. So the reason behind this was because of the very nature of the Mudarabah contracts. Mudarabah contracts, the returns are not guaranteed. When the returns are not guaranteed, this is counted as investments. So PIDM, they don't cover investments. So before the formation of IFSA 2013, Mudarabah accounts, they were covered by PIDM. However, they were guaranteed only up to a certain value. So they are only covered up to a value of 250,000 ringgit. And then after the formation of IFSA 2013, the ruling was no longer imposed, and then change of regulations and so on. So the coverage and all that, it just became invalid. So Mudarabah linked accounts, they are not valid under PIDM. They are not covered under PIDM. So yeah, that's all for me. Thank you.
Hello and Assalamualaikum. I'm Shazlina. Today I will discuss about question 10 and 11. Okay, what is in the question 10? Okay, the question 10 is eczema sectoral allocation of risk weightage asset and its relation to banking business strategy. Okay, the total risk weightage asset of the Maybank Islamic Berhad is RM60,618,081 ringgit. Maybank Islamic Berhad risk weightage asset include the credit risk, market risk, operational risk. In accordance with BNN guideline on the recognition and measurement of restricted profit sharing investment account and investment account as risk absorbers, the credit risk on the asset funded by the restricted profit sharing investment account and investment account are excluded from the capital adequacy ratio calculation. These weighted assets are used to determine the minimum amount of capital that must be held by banks and other institutions to reduce the risk of insolvency. The capital requirement is based on risk assessment for each type of bank asset. For example, a loan that is secured by a letter of credit is considered to be riskier and requires more capital than a mortgage loan that is secured with collateral. Most institutions say they have conducted programs to optimize capital and risk weightage asset, with an average risk weightage asset saving of 5.5%. Note that risk weightage asset optimization does not mean arbitrary adjustment to process or models or any kind of regulatory arbitrage, but rather steps to improve the coverage and granularity of risk models, the quality of data entered into the models, the eligibility of collateral, and improvement in risk weightage asset relevant process. In absolute terms, the largest saving has been achieved in reducing credit risk in the banking book. In relative terms, banks say that the bigger opportunities was in the trading book, where some banks say they were able to reduce this weightage asset by up to 37%. Mitigation of the significant increase in trading book capital requirement found in base 2.5 and base 3 is a priority and is crucial to the viability of some of their business. Okay, that's for the question 10. Okay, for the question 11, the question is at a capital ratio of 18% at a capital ratio for 8%, how much capital is allocated for credit, market, and operational risk? Okay, the calculation for the capital ratio is regulated capital divided by risk weightage assets. Okay, so risk weightage asset for the Maybank Islamic Berhad is, as I mentioned in question 10, is 60,618.81 ringgit. So therefore they have 2 times with 0.08%. Okay, therefore the capital allocated for credit market and operational risk is RM 4,849,446 and 48 cents. Thank you.